Imagine waking up one morning to find your money worth less than it was yesterday, your local shops half empty, the most talented people in your community quietly leaving for opportunities elsewhere. All while businesses shudder and the future feels more uncertain by the hour. The signs of strain are increasingly difficult to ignore. Across the industrial heartlands, factories that once operated at full capacity are running at a fraction of their previous output. Production lines have slowed or halted entirely, with machinery standing still for days at a time. In some cases, workers are sent home early with reduced pay, while others face furloughs or indefinite layoffs. The once reliable hum of manufacturing hubs has been replaced by a quieter, more uncertain rhythm. This downturn is not confined to a single sector. From heavy industry to consumer goods, output is declining, and the effects are rippling outward into related businesses, from logistics firms to raw materials suppliers. The national currency, a long-standing source of stability and pride, has tumbled to levels unseen in decades. Currency traders describe a sustained loss of confidence, with foreign exchange markets reacting sharply to each new economic indicator. The drop has not been a sudden collapse, but rather a grinding descent, each week bringing a new low. This steady erosion has made imports vastly more expensive, affecting everything from machinery parts to everyday consumer goods. Even domestically produced items have been hit by rising costs, as local manufacturers often rely on imported components. For ordinary citizens, the weakened currency translates into a palpable decline in purchasing power. A family that could once afford certain staples, without much thought now finds itself calculating the cost of each purchase. Prices in supermarkets shift upward from week to week. What was once a routine shopping trip now involves substitutions, compromises, or simply going without. This strain has intensified in urban centers where reliance on imported goods is greater, but rural areas are not immune. Farmers face higher costs for fuel, fertilizer, and equipment, which are often sourced abroad. Businesses, especially those dependent on foreign trade, face mounting challenges. Exporters find their overseas contracts more difficult to fulfill as supply chain disruptions and payment issues mount. Importers, on the other hand, struggle to cover the ballooning costs of bringing goods into the country. Some companies have begun renegotiating deals, delaying shipments, or halting imports altogether, creating shortages and forcing consumers toward lower quality alternatives. The retail sector, in particular, feels the weight of this economic shift as customer traffic declines and profit margins narrow. Financial institutions are caught in the middle of this turbulence. Banks, wary of the currency's volatility, have tightened lending standards, making it harder for both individuals and companies to secure credit. This in turn hampers investment, limits expansion, and slows economic activity further. The stock market has mirrored the currency's instability, with sharp drops following each new signal of trouble, erasing billions in value and further undermining public confidence. The psychological toll is no less significant than the material one. A falling currency carries with it a symbolic weight, signaling to citizens and the global community alike that the economic foundation is weaker than it once appeared. Confidence, once lost, is not easily restored, and each incremental drop reinforces a sense of vulnerability among the population. The current crisis is the result of a confluence of forces, each intensifying the impact of the others. The most visible of these is the collapse of trade, both in terms of exports and imports. Once, robust trade routes have slowed to a crawl as international buyers turn elsewhere and domestic producers find fewer markets for their goods. Ports that once bustled with cargo ships are operating at a fraction of their capacity, and warehouses stand half empty. Export volumes have dropped sharply, cutting into revenues that previously helped balance the national accounts. At the same time, imports have become scarcer and more expensive, not only because of the weakened currency, but also due to disrupted supply chains and strained relationships with trading partners. Capital flight compounds the damage. Investors, wary of political and economic uncertainty, have been moving funds out of the country at an accelerated pace. This exodus is not limited to large multinational corporations. Smaller firms and wealthy individuals are also transferring their assets abroad, seeking safety in more stable markets. Such movements create a vacuum in the domestic financial system, depriving businesses of the investment capital they need to sustain operations or pursue growth. In some cases, even companies with long histories of domestic loyalty have shifted their reserves overseas, citing the need to protect shareholder value. Financial restrictions imposed by external forces further constrict the economy's breathing room. Access to international credit markets has been sharply curtailed, raising borrowing costs for the government and private sector alike. Transactions that were once routine now face complex compliance hurdles, slowing the movement of money and goods. In sectors like energy and manufacturing, where international partnerships and technology imports are critical, these restrictions have cut off access to expertise, spare parts, advanced equipment. Even domestic projects that rely on foreign contractors or specialized materials have stalled as suppliers are unable or unwilling to navigate the tightening financial net. The interaction between these factors creates a feedback loop. Reduced trade lowers foreign currency reserves, which worsens the exchange rate. A weaker currency, in turn, inflates the cost of imports, making it harder for businesses to operate profitably. As companies falter, they cut jobs and investment, which diminishes overall economic activity and deepens the downturn. The perception of instability accelerates capital flight, draining more resources from the economy and reinforcing the cycle. On the ground, these abstract forces manifest in concrete ways. Shipping companies idle vessels rather than send them full on costly journeys. Farmers delay planting certain crops because imported seeds or fertilizers have become unaffordable. Technology firms shelve development plans as licensing fees and foreign software purchases grow prohibitively expensive. Bankers meet with clients to explain why loan terms have tightened yet again, while manufacturers scramble to find domestic substitutes for imported components, often settling for lower quality or higher prices. Each of these adjustments reflects an economy adapting to constraints it has not faced in decades. With every workaround carrying its own costs and compromises, inflation has surged into double digits, eroding the value of money at a pace that is felt in every corner of daily life. Prices for basic goods have risen steadily month after month, and what once seemed affordable now requires careful budgeting or is simply out of reach. The cost of food staples, bread, vegetables, has climbed sharply, forcing households to make substitutions or reduce consumption. Families accustomed to occasional indulgences are cutting them entirely, directing every available unit of currency toward essentials. The rise in transportation costs, driven by higher fuel prices, adds to the burden, affecting not just commuters but also the distribution of goods, which further inflates prices on store shelves. Wages have failed to keep pace with the surging cost of living. Salary increases, where they exist, are quickly swallowed by price hikes, leaving real income stagnant or declining. Pensioners, many on fixed incomes, are among the hardest hit, as monthly benefits that once covered basic needs now fall short before the month is out. Savings lose value as quickly as they are accumulated, eroding financial security and discouraging the habit of putting money aside. Even those who had built modest safety nets find them rapidly depleted as withdrawals become necessary to meet rising expenses. Small businesses face their own version of this strain. Suppliers raise their prices, often without warning, leaving shop owners scrambling to adjust their own price tags just to maintain slim profit margins. Restaurant owners confront the dual challenge of higher ingredient costs and customers with less disposable income, forcing them to make difficult choices between shrinking portions, altering menus, or risking losses. Retailers reduce inventory variety to focus on items that are still within the reach of their clientele, but such adjustments come at the cost of customer satisfaction and loyalty. The housing market reflects these pressures as well. Rising construction costs, fueled by more expensive materials and labor, push property prices upward even as fewer people can afford to buy. Renters see steady increases in monthly payments, while landlords point to their own swelling expenses for maintenance and utilities. For young adults, the dream of home ownership recedes further into the distance, replaced by the immediate concern of managing day-to-day living costs. Inflation's reach extends beyond the tangible costs of goods and services. It shapes expectations and behavior. Consumers, anticipating further price increases, sometimes rush to buy non-perishable goods in bulk, which can trigger shortages and make the situation worse. Businesses, uncertain about future costs, delay investment decisions, putting off expansion plans or hiring freezes to preserve cash flow. In financial markets, the lack of confidence in the stability of the currency drives more people toward hard assets or foreign currencies, accelerating capital flight. This upward spiral of prices exerts a psychological toll as well. People adjust to living with less, cutting back not only on luxuries but also on aspects of life once considered essential. The erosion of purchasing power changes the rhythm of economic activity, replacing optimism with a cautious, almost defensive mindset that pervades transactions large and small. In recent months, shortages of essential goods have begun to reappear, evoking memories of a period many believe was long past. In several regions, queues form outside grocery stores and markets well before opening hours, with residents hoping to secure items that may sell out quickly. Shelves that once displayed an abundance of products now stand half empty, especially in sections for cooking oil, sugar, flour, and other staples. The scarcity is not uniform across the country, but the disruptions are widespread enough to create an atmosphere of uncertainty. People have grown accustomed to the idea that if something is available today, it may not be tomorrow, prompting stockpiling behaviors that strain supply even further. The causes of these shortages are varied but interconnected. Import delays play a significant role, as the weakened currency makes it harder for distributors to purchase goods from abroad. Shipping companies, facing increased costs and logistical complications, often prioritize other markets, leaving domestic retailers with unpredictable deliveries. Some products do arrive, but in reduced quantities insufficient to meet demand. In industries reliant on imported components, such as packaged foods or personal care items, production slowdowns have cascaded into the retail sector, leaving gaps on shelves and prompting consumers to search for alternatives. Even goods produced domestically are not immune to disruption. Farmers face higher costs for fertilizers, seeds, and fuel, all of which have been affected by rising global prices and restricted access to foreign suppliers. When these inputs become too costly or scarce, planting decisions are altered, leading to reduced harvests that feed directly into shortages at the consumer level. In manufacturing, machinery breakdowns take longer to repair due to a lack of spare parts, creating production bottlenecks that further limit supply. The effects of scarcity are visible not only in physical shortages, but also in the transformation of markets themselves. Informal trading networks have expanded, with individuals buying goods in bulk when they appear and reselling them at inflated prices. While this practice ensures that some goods remain available, it pushes prices even higher, effectively placing them out of reach for lower-income households. Barter arrangements, once rare in urban settings, have begun to resurface in small pockets, with people exchanging surplus goods directly rather than relying on cash transactions. These conditions feed a growing sense of economic unease. Shoppers adapt by altering their purchasing patterns, buying in larger quantities when possible, accepting lower quality substitutes, or doing without certain products altogether. For families with children or elderly members, the search for particular food items or medicines can become a daily preoccupation, consuming time and energy that might otherwise be spent on work or leisure. Each instance of scarcity reinforces a broader perception that the systems once relied upon to ensure steady access to basic needs are no longer functioning as they should, fostering both frustration and resignation among the population. Small enterprises across the country are bearing the brunt of the economic downturn, with closures becoming an increasingly common sight in both bustling urban districts and smaller towns. Storefronts that once drew steady streams of customers now stand dark, their windows covered with paper or displaying handwritten notices of temporarily closed that often prove permanent. Many owners describe a similar chain of events: rising costs, shrinking sales, and an inability to secure affordable credit. For some, the tipping point comes when rent or utility bills exceed what diminished revenues can support, forcing them to cease operations altogether. The retail sector has been particularly hard hit, with consumers prioritizing essential goods and delaying discretionary purchases. Shops selling clothing, electronics, or household items see fewer customers and smaller transactions, seasonal peaks that once offered a financial cushion. Holidays, festivals, or tourist influxes now fail to deliver the same boost, leaving businesses without the reserves to weather lean months. In restaurants and cafes, the combination of more expensive ingredients and fewer patrons has driven margins so low that owners face a stark choice between cutting quality to save money or closing their doors. Unemployment is rising as these closures ripple through local economies. Each shuttered shop or idled workshop represents not just the loss of a single livelihood, but often the displacement of multiple employees. The impact spreads further when suppliers lose key clients, delivery services see fewer orders, and landlords face vacancies. Even when workers do find new employment, it is often in lower-paying or part-time roles, deepening the strain on household budgets. Official statistics, while acknowledging the increase in joblessness, tend to lag behind reality, masking the true extent of underemployment and informal work arrangements that have become more common. For entrepreneurs who attempt to adapt rather than close, survival often comes at the cost of difficult compromises. Some reduce staff to the bare minimum, taking on multiple roles themselves in an effort to cut payroll expenses. Others scale back product offerings, limit operating hours, or shift to cash-only transactions to avoid bank fees. While these measures can buy time, they also risk alienating customers who may turn to larger competitors or informal markets for greater convenience and reliability. In certain sectors, the downturn has accelerated an already growing concentration of economic activity in the hands of a few large players. Big retailers and chains, with greater access to financing and bulk purchasing power, can absorb cost increases more effectively, allowing them to maintain lower prices than smaller rivals. This imbalance has led to the quiet disappearance of many independent businesses that once gave neighborhoods their distinctive character. The psychological toll on business owners is significant. Years of investment, financial, emotional, and personal, can be undone in a matter of months, leaving behind not only financial loss, but also a sense of displacement. In communities where small businesses are a primary source of employment and identity, each closure is felt as both an economic setback and a personal blow to the shared fabric of daily life. The loss of foreign investment has drained a vital source of capital that once fueled growth, innovation, and infrastructure projects. In previous years, international firms brought in not only funding, but also technology transfers, managerial expertise, access to global markets. Now, new investment proposals have slowed to a trickle, and existing projects are being put on hold or canceled outright. Investors cite an unpredictable business environment, volatile currency exchange rates, and concerns over long-term stability as reasons for pulling back. Without this external capital, the government and private sector alike face limited options for financing large-scale developments, from manufacturing plants to energy pipelines. At the same time, a steady outflow of skilled labor is reshaping the country's economic landscape. Engineers, scientists, medical professionals, and other specialists are seeking opportunities abroad, drawn by higher salaries, better working conditions, and greater political or economic security. Many who leave take with them not only their expertise, but also their networks and the capacity to train the next generation of workers. This talent drain creates gaps in critical sectors, slowing research and development, reducing productivity, forcing employers to either lower hiring standards or abandon certain projects altogether. The combined effects of reduced investment and brain drain are mutually reinforcing. The absence of skilled professionals makes the market less attractive to foreign investors, who prefer environments with a deep pool of talent. In turn, the lack of fresh investment diminishes job opportunities for highly trained workers, encouraging even more to emigrate. Over time, this cycle threatens to erode the competitiveness of industries that once held strong positions internationally. Advanced manufacturing, technology development, specialized services, which rely heavily on expertise and modern equipment, are especially vulnerable to this decline. The long-term consequences extend beyond immediate economic metrics. Infrastructure that depends on regular upgrades, power grids, transportation networks, communication systems, risks falling behind global standards when funding and expertise are in short supply. Educational institutions may struggle to retain top faculty or modernize their programs, resulting in graduates less prepared for the demands of a rapidly evolving global economy. Without new investment, opportunities for diversification dwindle, leaving the economy more dependent on a narrower set of industries, which increases vulnerability to future shocks. In the business community, confidence is further undermined by the perception that the best opportunities now lay elsewhere. Entrepreneurs with globally viable ideas often choose to establish their companies abroad, where access to investors, stable regulations, and skilled staff is more readily available. This relocation of potential growth stories deprives the domestic economy not only of revenue, but also of the innovation and dynamism that help sustain resilience during hard times. As more capital and talent move outward, the economic structure becomes less capable of generating the momentum needed to recover fully from the present crisis, leaving an enduring imprint on the nation's future trajectory.